Well, welcome back. We are kicking off the fourth quarter today. Markets are higher going into the quarter. Dow Industrials up 70 points, S&P up 8, and the Nasdaq up 27. Markets ended the third quarter with gains as well, enough to prolong an already robust bull market, which is now the longest on record. Dow Industrials for the quarter, as you see, up 1%, S&P up 1%, and the Nasdaq was lower. Joining us right now is Portfolio Wealth Advisors President and Chief Investment Officer Lee Munson. Lee, good to see you. Thanks so much for joining us.
I love to be here.
What kind of a quarter are you expecting, fourth quarter?
I'm expecting a big quarter. I really thought we'd see volatility right now. I don't think we're going to see any volatility. I think all those people betting on it are going to lose. The estimates have come down so much this summer. All 11 sectors of the S&P have lowered guidance. So I think that we're going to see the earnings and everything get sandbagged. I think you're going to see more upside. I think stocks are where you're going to be for the next 3 months.
So you think things are going well in terms of the backdrop? Because there's this new S&P note this morning saying that the risk of a U.S. recession in the U.S. has climbed 30 to 35% due to the weak corporate earnings that we're expecting and other downward trends.
No, we've got $3.4, almost $3.5 trillion sitting in cash. We already know about the yield curve inversion signaling a recession next year. So I don't think this is really new news. I think the market dynamic, the way you make money here, is understanding what expectations are. I think there's a lot of fear of missing out. We have a whole sector of retail investors, which I deal with one-on-one. And these people have a lot of cash on the sidelines and are so concerned we're going to crawl that wall of worry. So I think that the expectations is really the dynamic.
Walk us through the earnings outlook. What are you expecting for the fourth quarter, and also looking into 2020? What kind of growth are we going to get on the earnings front?
Well, I think that once you start getting into fourth quarter, we're going to find out that nothing's wrong. And I think that we're going to have a pretty good first quarter going into next year. And that's because we still have the housing market strong. We have consumers getting back in their pocket maybe 5 or 10% on refis. I mean, this refi boom is real.
But what are the numbers? Are we talking, are the days of double-digit earnings growth
They're
over?
gone. They're gone.
Low single?
Low single. Low single. I think you're looking at maybe 3 to 6% on average. I think the estimates that they have for next year are off by 30 to 40%. So again, I think that the story now is the next 3 to 6 months, and everything's going to look fine. But then that slowdown in manufacturing, it's going to eventually start getting more pervasive into earnings. And I think by the middle of next year, we're going to have a market that could be in real trouble. But that doesn't mean that we don't want to make money for the next 3 months.
I mean, isn't it the case that people are moving into stocks right now because there's just nowhere else to go?
Yeah,
returns are so low in bonds, and the rest of the world certainly doesn't look very good. Yeah, but so stocks are the only place to go. But that might get you a positive return, but it's not going to make you a fortune.
And you said earnings estimates are 30 to 40% off?
I believe next year's earning estimates of high single digits. They're talking about 7 to 9% later next year. I don't see how we're going to do that.
Go ahead.
Not with the manufacturing overhang right now, right?
I was going to say cash, you don't lose money, John. You can lose money in bonds and you can lose money in stocks, but if you just park your money in cash, I mean, that's an alternative.
Well,
you don't get
you're
paid.
In Germany, you're losing it there.
I know, but we're not in Germany.
Well, let's talk about Germany and negative rates and where rates are right now, because yields on, well, not even a roller coaster ride globally, but a move lower globally. Investors are actually paying to keep their money there. Around $15 trillion in government debt around the world now has a negative yield. What do you do with that? What does that tell us?
So one thing that's going to, right now, you can, if you're a European investor, you can still sell euros, buy dollars, and after hedging that, you can still make money on a U.S. Treasury. That trade's going to disappear soon, and that's not a trade that everyday investors are making. Recently, what we've been doing, we've been taking off some of our exposure to intermediate bonds. We've been buying some gold. I've had to tell my clients I'm not turning into an Armageddon, newsletter writer guy. But I think when you look at the cost to carry right now, it's cheaper to own gold and that cost to carry than it is European debt or any of this negative yielding debt. I also think that you have to wonder what's going on with the European investor, a German investor who can buy a basket through a cheap ETF of their assets at 1.3 times book, getting a 4% yield, and they would rather buy bonds. And so I think you really have to think, how is this different in Europe than it was here in the United States in the summer of 2009 when the S&P was yielding 4% and everybody like George Soros said there'll never be a recovery. I think there's going to be a recovery because we priced in no Brexit, we priced in everything, but yet Italian banks are getting less worse as the days go by.
So just to be clear, you're expecting a strong fourth quarter, but you do think market has trouble next year?
Absolutely. I think you've got another 6 months of free sailing this market of low rates, too much cash on the sidelines, and negative rates pushing money into the U.S., not just in the stocks, but the U.S.
That was the point I was making, that all this money from the rest of the world, there's no other place to go but U.S. stocks right now.
Coming to the United States. Lee, it's great to have you. Thanks so much. Lee Munson joining us.